Past performance of any mutual fund scheme is going to play a very vital role while we are going to select a mutual fund scheme, either for investment if we are investor or as a mutual fund distributor to advise our client. And in this video, I am going to touch upon what is the practice which is followed by various mutual fund companies to publish the performance of their mutual fund schemes, how you are going to read into it, and why it is important to look into the returns of the schemes from the rolling returns point of view, and how it is going to benefit in selecting the right mutual fund scheme for you as an investor or as a mutual fund distributor. Hello everyone, I'm Shobhit. I'm a FinBiz growth expert and founder of FinBiz Growth Club. We are an aspiring community of new age mutual fund distributors who are determined to change how India invests. So first, let's talk about the nomenclature or the practice which most of the mutual fund companies are taking into consideration when they are publishing their performance of their schemes. And it is called trailing returns or point-to-point returns. Now, what point-to-point returns means? If they are going to take the NAV of per unit of that scheme on a particular date, and from that day, suppose they are publishing a 1-year return, 365 days back date, on that day, whatever is the NAV on that parameter, they are going to publish the performance. So let's assume today is say 1st of April 2022. And if I have to publish the return of last 1 year of that scheme in a point-to-point returns, if I'm going to publish, then I'm going to see the NAV of that scheme on 1st April 2021, and then on both these numbers I'm going to calculate what is the return which scheme has given on a particular time period. Now, there are some flaws in this returns published which most of the mutual fund companies are publishing, and by the way, it has been given by the SEBI to publish the return in this fashion. Okay, so if you are taking only the returns based upon a particular date NAV, we are missing the volatility which may happen during the period, because these are the investments where market is going to go up or down on a various time interval. And if we are not able to understand that how volatile the fund would have been, we are not going to get a clear picture. At the same time, if 1 year back on that particular day market has corrected by say 2% or 5%, and I have invested, then automatically my returns would have been much better if I am looking at a particular date performance of the scheme. So market factors are also going to have a very huge impact in terms of if we are going to see on a particular day performance. Ideally, we don't know when we are going to invest. So if we are going to take a point-to-point performance, it is not going to give us a clear picture. And that's why the trailing returns which most of the companies are publishing, it is not going to give us a good idea how well the scheme has performed. Ideally, we need to look at the performance of the scheme, not only in the terms of the returns, but also in terms of the volatility. How often the scheme returns or the performance has been up and down. If it is fluctuating too many times, this means that these funds are going to give us lot of sleepless nights. We would prefer a scheme which is going to be consistent in its performance, and that is going to show into the lesser volatility in those schemes. And that's where rolling returns are going to come into play. But before going into that, let me show you how we are going to be reading into trailing return performance. So I have taken a screenshot from one of the media websites which are publishing their returns. And if you look at this performance, the NAV or the performance, they have measured NAV as on 1st of April 2022. So if you see the 1 week performance, 1 month performance, 3 month performance, it is just like that. They are going to take, suppose I'm talking about 6 months performance. This means what? This means that exactly 6 months back, whatever was the NAV and whatever the NAV is as on 1st of April 2022, they are going to take these 2 days NAV and they are going to calculate the return. From 1 year or more, they are going to analyze the return and then they are going to publish the result. So this way it is a point-to-point return or a trailing return which you need to understand. The other way which some of the companies are publishing, which is in terms of absolute return and not annualized return. So let me give you some examples so that it makes more sense to you. So if you look at the returns which has been published by some another media company, here you can see they are publishing absolute return in the 1 year time period, 2 year time period, 3 years time period, and 5 years time period, and so on and so forth. This means what? They are showing you not annualized return, but the absolute return which the scheme has generated if you have invested in that scheme for say 2 years time period. So the return which in the 2 years time period the scheme has generated is 213.78%. Now what we need to understand, this is an absolute return. In between whatever has happened, that has not been captured by the scheme. And that's where the flaw lies. If we are going to see only point-to-point return, it may be simple to understand, but it is not going to give us a clear-cut indication or a picture how good or bad the performance of the scheme would be or would have been in the past in terms of volatility, in terms of risk that the scheme would have gone through. And that's where the rolling returns comes into play. In rolling return, what we do and how we calculate, let me explain to you. In rolling return, suppose we are assuming that we want to get a rolling return of say 3 years time period. So what we are going to do, we are going to take the average on a particular time basis. So it may be every day, every week, every month, every 6 months, or every year. Now this means what? Suppose I want to see 3 years rolling return of a particular scheme on a daily basis. Then what I am going to do, today is 1st of April 2022, let's assume. So I am going to be taking the NAV of, suppose today I am going to calculate, then today is 1st of April 2022, then 3 years back it should be 1st of April 2019, and from 2019 I am going to take the NAV and today's NAV, and then I am going to calculate, and it will keep on rolling on a daily basis if I am calculating my rolling returns on a daily parameter. If it is a weekly parameter, then how it is going to happen? In a weekly parameter, it is going to be jumping by a 7 days time period. In a monthly, it is going to jump by 30 days time period. So what is going to happen now, since we are taking the consideration of the NAV movement on a daily basis or a weekly basis or a monthly basis, it is going to give us a much better indication that over a time period how the fund has been performing on a specific time buckets. So it is going to give us a very clear picture that whether the fund has been consistent or not. And once you look at the rolling returns performance of any scheme, it is going to give us a lot of data points, which is going to give us a lot of clarity how the fund has been performing. So rolling returns are going to make you a performer only if you are performing on average on most of the days. You are not a one-day performer where in point to point, even if you are a one-day performer, your returns would be misleading for you to take that investment decision. Let me show you a result of rolling returns and how you are going to read into it so that it is going to give you much better idea. So if you look at this is a rolling return performance of flexi cap funds, of some of the funds which I have taken into, and if I want to read into this rolling return performance, how I am going to look into, if you look at the key parameters, it is going to show you average return, then median returns, and maximum return and minimum returns. So it is going to show us what kind of performance on average or a median return the fund has given. So it is going to give us a clear-cut parameters and numbers, which is going to give us an idea how consistent the fund would have been over a specific time period. But more importantly, I want you guys to look into the return consistency. If you look at the return consistency parameter, it is going to show us how many times out of 100 the fund has given negative returns, how much times on average fund has given a return between 0 to 8%, then 8 to 12, 12 to 15, and 15 to 20, and 20 and above. Now, important thing which I would like you guys to understand is, if I am going to be loving to select a scheme which is going to give me always our maximum time return is going to be more than 20%, and if you are of that thought process that I am going to select a scheme which has given the highest number of times returns which is more than 20%, then you need to also consider this fact that if a fund has given a high return for a longer period of time, it means that fund also carries a higher risk. So if you want to look into the performance from a different perspective, what I would like you guys to understand is, if that fund has most of the time has given a return which is 0 to 8 or 8 to 12% majority of the time, it means that fund is conservative fund. It is not taking much of a risk, and that's where the performance lies between 8 to 12 or 0 to 8 most of the time. But if the fund most of the time is coming into the last quadrant of greater than 20%, this means that fund has been very aggressive, and that's why they were able to deliver higher return maximum point of time. So it is up to you to decide whether you want to go for an aggressive investment portfolio or a conservative investment portfolio. More importantly, if you are looking for a fund which would be consistent over a longer period of time, you don't want to be in any one corner, then you need to be picking a fund which is very consistent in terms of 12 to 15% or 15 to 20% most of the time period. If that fund are most of the time period in that quadrant, I think that is going to give you a much better indication that the fund is neither going to give you sleepless nights in case the fund is not performing well, or neither it is going to give you exuberance by performing too much or by performing extraordinary in a good time. So that also we need to be taking into consideration whenever you are looking into the rolling returns of the scheme. Rolling returns are going to give you an average performance over a longer period of time, and that is going to give you an insight whether that fund is good for you or not. So I have shared some insights which you need to be looking into when you are selecting a scheme based upon performance, and I would highly recommend that you should be looking at rolling returns so that you get an idea that on average over a period of time how funds have been performing. Where to get the returns or rolling returns of the schemes, I am going to leave some free resources in the description. I want you guys to download those resources, and then you can do your own R&D, your own homework to select the right mutual fund scheme for you. In case this has given a new dimension for you, in case this information was useful for you, I would love you guys to hit that thumbs up button, subscribe to our channel, so that whenever we have something new to offer, you guys will be the first one to know. Thank you very much for joining in. I'm going to see you next time. Please take care.